Global stock markets are sleepwalking their way towards the edge of a giant cliff, with central banks now forecasting interest rates higher for longer, and all the accrued savings from the COVID stimulus bonanza now coming to an end. Many investors seem completely unaware to the dangers ahead. I'm Biko Konstantinos, and that's what we're going to talk about today. If you're interested in property, make sure you stick around because a stock market collapse would have a massive impact on the housing market. And if you're interested in the best content on the internet, are you watching this? But if you're interested in some pretty good content on the housing market, stock market, and everything in between, consider subscribing to my channel. I'll keep you up to date with analysis and commentary. So why could stock markets be headed for collapse? Now, to really increase the chance of a full-blown stock market crash, you first need to have a stock market bubble. And more than just a stock market bubble, Jeremy Grantham believes that post-COVID we've had a super bubble, or what some refer to as an everything bubble, where you have a dangerous mix of cross-asset overvaluation. So basically bubbles across multiple assets, including bonds, housing, and stocks. Now, if we all turn our minds back to 2021, I think we can all agree that the market saw bubble mania, where speculative buying of assets was everywhere. Government intervention and unprecedented stimulus measures created speculation on steroids, with crazy rises in cryptocurrencies, NFTs, meme stocks, and even more stable assets like real estate and general stocks seeing unbelievable returns. So yes, I 100% agree with Grantham that we have witnessed an asset bubble, but how will this bubble end? If we agree we've had a stock market bubble, it's very important to consider the stages of a typical asset bubble so we can try and work out where we currently sit within that bubble and what could be coming up next. In this widely accepted graphic of the anatomy of a bubble, we can see that there's a sharp appreciation before it reaches the top. And during this blow-off type period, you've got increased media attention, everyone's excited due to the sharp gains, more and more greeds entering the market, then delusion as people think it's still good value buying here. A new paradigm is when people think that this is the norm. So for example, when cryptocurrencies had skyrocketed, but many people thought even at this stage that they'd continue skyrocketing. And that's what's known as the new paradigm. And you can see that the higher the prices go, the more the assets become overvalued. So once you reach the inevitable top, prices can fall quite sharply in what's called denial. And then we have a bull trap period where the psychology of the market is returned to normal. When most market participants think that the worst is behind us, it looks like the stock market might be back to trading normal, similar maybe to this period where you see gradual growth. If we look at the S&P 500, we can see how the bubble formed straight after these COVID declines and continued much higher than you'd expect, especially when you consider we had global lockdown, massive unemployment, and many business closures. So after the peak, we did see some significant declines, but the big question we need to ask ourselves, is this the end of the deflating of the bubble, or are we following the stages perfectly, with this latest rise seeing investors think we're returning back to normal, only to be shocked as the real collapse of this bubble really starts to form after this? One sign that the recent stock market rally could be short-lived is because most of the rally has been due to massive buying demand of AI-related stocks. You see, a strong rally in 7 large tech stocks has been the main contributor to the stock market going up in 2023. Check out the S&P with those 7 large companies included compared to where they would have been if those 7 companies were actually removed from the index. So this is a great signal that the recent stock market rally could actually turn out to be a bull trap, which means bulls get trapped into buying on the way up only to find the price turn sharply downwards shortly after. One person who could be forecasting a stock market crash is Michael Burry. Burry, also known as the Big Short, became famous for predicting the housing market collapse during the global financial crisis. According to filings from Burry's investment fund, he recently bet more more than 1.6 billion on short trades against the stock market. So in other words, he's opened short positions which actually make money when prices go down. So does Michael Burry know that this recent stock market rally is just a fake sucker rally to lure buyers in before the next phase downwards? He just might be onto something. Now, pandemic stimulus and intervention created a cash bonanza for many people, which is why we ended up with the everything bubble in the first place. But ultra sharp interest rates designed to control that out of control inflation has meant that all the extra savings accrued post-COVID has nearly all gone. If we look at this graph, we can see the pandemic policies created a massive boost in personal excess savings to the like of 2.1 trillion in the US. But now with sharp interest rates, massive credit card debt, etc., we're seeing a drawdown of excess savings to the like of 1.9 trillion. So the benefits are all gone, but the pain might only just be getting started. And everyone seems pretty relaxed about it. And that's because the jobs market is very tight. So nearly everyone who can work is currently working. And that helps to limit any downside economic effects. But now that the excess savings is all but gone, and mortgage rates and costs of living are sky high, we're likely to see a downturn in consumer spending, which cuts into company profits. And as companies try to maintain their profit margins, they try to reduce their biggest expenses, which are employees. So we end up seeing more people laid off and unemployment starts to rise. So it makes logical sense that we will see unemployment rise from here because it's been abnormally low due to the aftermath of the pandemic policies. Something else that could greatly affect global stock markets is China's economic woes. You see, China for many years has been an unstoppable economic force, but recently they've been plagued with a series of crises. They've got a real estate crisis with falling property prices and the collapse of massive companies like Evergrande. They've got a larger debt crisis with trillions owed by local governments, financial affiliates, and real estate developers. And they're also struggling with a youth unemployment crisis, with the figures showing that youth unemployment had risen to 21% before they stopped reporting on it. So this economic deterioration in China could lead to reduced consumer spending, and that could have a negative impact on global companies that previously received a lot of spending from China. It could also negatively impact commodity companies who might mine for raw materials or oil, etc., because China has previously had an insatiable desire for raw materials. And because of this, many countries have benefited greatly. Over the past decade, China has been the source of more than 40% of global economic growth, compared to 22% from the US and just 9% from the Eurozone. So from those figures, you can see how an economic deterioration in China could greatly affect global economic growth, and that could send global stock markets plummeting. Now, what about property? Global property prices have been one of the biggest benefactors of ultra-loose pandemic policies. But just like the excess savings are now coming to an end in the US, will that crazy speculative demand for property start to wane in the months ahead as property markets start to fall over? Like I mentioned, many central banks are now calling for interest rates to stay higher for longer. This is the complete opposite of the ultra cheap debt we've seen over the last decade, and many people are just not used to it. Because we've seen real estate prices rise so sharply over the past few years, nearly every property owner feels a lot wealthier, and when you feel wealthier, you're much more comfortable to spend your money into the economy. But is this sort of a fake sense of wealth because property prices were so artificially inflated due to ultra loose monetary policies? And if some of the effects of those policies start to reverse and property prices fall, are we going to start to see the loss of wealth effect happen, where people feel less wealthy and then tend to spend less into the economy because they want to protect what wealth they have and they're afraid of losing more? So as we've seen, the global economy might look okay from the outside, sort of like looking at a dam from the distance where you can't see the multiple cracks start to form in the dam foundations. And while they're just cracks, everything will just keep running as normal. But if those cracks start to get too big, there could come a tipping point where the entire dam collapses. Now, because of the booming property market, low unemployment, the mini AI boom, we've had this nice rally where it seems everything's fine and we've returned back to normal. But when the market realizes that things are a lot worse than they seem, we could see some extremely sharp declines in the stock market, which can sometimes lead to complete capitulation where everyone starts dumping their stocks. If we have a quick look at the dot-com bubble, we can see a massive spike in the Nasdaq, which led to the all-time high being hit in early 2000. We saw a sharp retracement from the high, but then a significant rally before the entire market collapsed and didn't bottom until October 2002, around 2.5 years after the peak. So we've got two massive questions to ask ourselves. First, have we witnessed a stock market bubble with what we've seen post-COVID? Because if we have, then all bubbles deflate somehow. They don't all fall the same amount, but they all have a period where the excess greed and speculation start to unwind. And if the answer is yes, what part of the bubble deflation are we currently sitting at? If we're sitting around this position, comparing ourselves to the dot-com bubble, then a massive collapse in the stock market might be ahead of us. I'm Biko Konstantinos.